Chapter 3, Financial Accounting, the Adjusting Process, Part 2 of 3. So in Part 1 of the adjusting process, we started talking about the fact that unadjusted trial balances are just that. They need adjusting because they're unadjusted, and there are accounts that aren't accurate. They don't reflect the financial position of the company. They don't reflect the revenues or the expenses according to GAAP and according to the matching principle. So in this section of Chapter 3, we're going to learn a little bit about adjusting entries. Sometimes they're called AJEs or adjusting journal entries. We've already talked about accruals and deferrals, talking about accrued expenses and deferred expenses, and we're going to talk about, in this section, some of the specific examples. So first we're going to look at what we had in the last chapter, which was Net Solutions. We've been following this company for a bit. And Net Solutions, this is their December 31st, 2017. Their account numbers, their account titles from their chart of accounts, the accounts with a debit balance after all the transactions were posted, and the accounts with a credit balance. Double entry accounting, debits and credits equal. So this is where we start. It's unadjusted because we have lots of accounts through here that need adjusting. One of the tricks of the trade is the fact that cash never needs adjusting because our cash account is... Okay, so we'll start with an expanded chart of accounts, and this gives us details about new accounts that have been added. So if you look closely, you can of course see and highlight that there are several accounts that we've added. Something called accumulated depreciation. That's a tricky one. Something called wages payable. That's a liability. Rent revenue is a different category of revenue. Insurance expense and depreciation expense. So we're going to talk about each one of these. Okay, so let's start talking about accrued revenues. Revenues that have not been yet recorded, and it says that our company, Net Solutions, has signed an agreement with a customer, and they're going to be receiving $20 an hour, but the customer isn't going to pay them until January 15th. That's when the bill goes out. They've already done 25 hours of service. So this is where we start connecting chapters. The matching principle says that revenues and expenses should be recorded in the period in which they're earned. So if we're trying to adjust our records as of December 31st, we have to record the revenue that was earned through December 31st, even if we haven't received it in cash. And in this case, this adjustment entry is required because we haven't even sent a bill yet. So let's put this again. Let's say this one more time. This revenue, which we find out is $500, 25 hours at $20 an hour, this revenue is being billed because this company earned the money, they did the work, but they have not yet recorded the revenue, they've not even sent a bill. So let's look at the accounting equation impact. First, let's look at the accounts receivable. They go up. This company does in fact owe Net Solutions $500. And on the other side, revenues go up. Revenues are part of stockholders' equity. They're increased by a credit. Accounts receivable are an asset, and they are increased by a credit. So again, our debits and our credits equal. Let's move to an accrued expense. In this example, we're talking about wage expense. And this company pays its employees biweekly. That means every other week. Every other Friday. That happens with many companies. And it says during December, Net Solutions paid wages on December 13th and December 27th. Okay, the year ends on December 31st. And Net Solution owes $250 worth of wages. Now, I think a big misconception by a lot of students is that this company is not paying their wages the way they're supposed to. But by saying that they owe these wages for Monday and Tuesday, the issue is this: it's not payday yet. So employees don't get a check just because it's the end of the accounting period. However, the accounting department has to record the fact that they owe these wages even though they haven't been paid. So the journal entry is going to be to debit wage expense and to credit wages payable. So let's look at it on the accounting equation. We're going to record an expense even though we haven't paid it yet because of the matching principle. We're matching the expenses of wage expense with the revenue that we've earned. So if we scroll through, we can see that wage expenses increased by a debit of $250, and this expense goes under stockholders' equity. It reduces our revenue. Revenues are increased by a credit, and because expenses reduce revenue, expenses are increased by a debit. Again, another way to remember that is debits are used to increase dividends, expenses, and assets, DEA. Okay, part 2 of this transaction is to record wages payable. Wages payable are a liability. They're increased by a credit. Everything on the right-hand side of the accounting equation is increased by a credit. Let's move forward to look at this, if we can, with the way that the dates work. Okay, so the total wages for the month of December are $2,400. The first 2 weeks, and this is the end of the first 2 weeks, the 13th, this is what's paid. The next 2 weeks, on the 27th, they made a payroll. Now, payroll's not going to happen for another 2 weeks, so we're not going to pay anybody until January the 10th, because this company pays every 2 weeks, so we can kind of lump it off this way. If you can follow, it's kind of hard to draw with a pointer and a mouse, but hopefully you can follow this. So this is a 2-week period right here. And so we have to record these 2 days right here. And even though they're not going to be paid until down here in January the 10th, it's almost as if the employee said, I quit on December the 31st. If the employee said that, the company would still owe them wages, and so they have to be recorded because of the matching principle, because it is a liability of the company, because we do accrual basis accounting. Accrued wages have to be recorded whether or not the payroll date has occurred, whenever they are due and when they match with the revenue. So this is sometimes this on their homework, and they take some time to do it on their homework. Let's look at another one. Unearned revenues. Okay, these are revenues that need to be recognized. So in this example, if you recall, this is chapter 2, I think, the company, Net Solutions, received $360 in advance, and this was unearned rent. It was received and unearned, meaning they got the money before they earned the money, before they earned the revenue. And so because of this situation, and lots of times people say, hey, I want my rent in advance. So because of this unearned rent that was received in advance, we have to record the rent that has finally been earned each month. So at the end of December, from December 1st until December 31st, we've earned 1 month, and so we take that $360 and we divide it by 3, and we come up with the fact that there's a $120 debit to unearned rent and a credit to rent revenue. Now you might want to pause the video here and think about the rules of debit and credit again. So what we have is revenue being earned. Revenue is stockholders' equity. It's increased by a credit. Now this time when revenue was earned, we didn't get a check. We don't have an accounts receivable. We show that out of the $360 that was paid in advance, we have now earned, as of December 31st, $120. Notice the adjusted balance right here of $240. That's what's left over. And we'll see that when we do our trial balance at the end. Okay, so our unearned rent has gone down, but our stockholders' equity has gone up. Okay, supplies. We've done one of these before. We're going to do another one. If we looked at the unadjusted trial balance on December 31st, we'll find that there was $2,000 there. And they did a count and they said, looks like there's $760 left. So this $760 shows the amount on hand, and that means $1,240 is used. Now I'm going to stop and throw a little ethics in here. Just an internal control, as I call them. An internal control is a control set up to make sure that your employees, or that nothing can be stolen, to ensure that cash is accounted for, your assets are accounted for. And it's not a good, strong internal control to go in and see by physical count how much has been used, because some of that $1,240 may have been stolen, broken, it may have been miscounted. So this isn't the best control, but we'll talk about internal controls in a future chapter. And for now, for this example, what we have is $2,000 to start with, and $760 is going to be our ending balance. So we've got supplies expense, just like we did in the past, of $1,240 to record because that's what was used. And the supplies asset account, $1,240. And again, here's our supplies account. We've adjusted it, and it shows the correct adjusted balance. And the supplies show that we have a beginning balance plus we've made this adjustment. So here's our ending balance in supplies, because we've taken two different accountings for the month of November and December to see how much we have left in supplies. Supplies go up. Sorry, let me back up a minute. Supplies expense goes up, and the supplies asset account goes down. Okay, let's talk about prepaid insurance. We've said this before. When you buy insurance for your car or for your home or even life insurance, it's always paid in advance. So this company did just that. Net Solutions prepaid insurance in advance for $2,400. And this insurance that they prepaid was for 12 months, which came out to be $200 a month. And so we record this adjusting entry to show that our prepaid insurance, which is an asset, has gone down. Now, again, remind yourself, prepaid insurance is an asset because if this was, for example, on a car, and that car was stolen or wrecked and never used again, you would get a refund. So this is showing that 1 month has expired and insurance expense has increased through the debit. Prepaid insurance has decreased through a credit.